Well, good morning and welcome to another UIC podcast. As always, Tom Kovatch is with me, and my name is Boris Khovitch. Tom, today we talked about this, and I thought that we would go into the insurance procurement process and some of the different variables that are associated with it.
Terrific. Well, it is one of the subjects that comes up most often, either in an interview with our clients because they ask us, what is the best process? How should it work? What are the variables and things that we need to think about? And so it is an interesting topic with a lot of nuances, which I think most people, customers or insureds, really don't think a lot about.
Sure.
So let's just kind of run through the basics of what that process is,
Absolutely.
starting with the foundation, right? So the foundation for any good risk management program starts with knowledge, and the knowledge base that the client has or the purchaser, that of the broker who's going to be representing them usually, and the insurer who's going to be putting out their capital or accepting that risk. So the better the knowledge base is of all three of those parties, the better the result is going to be, both in terms of the risk being transferred and the cost associated with that transfer. In short, best premium or lowest premium for the maximum amount of coverage that can be achieved for maximum protection.
Sure.
The issues that surround the foundation are many times clients don't have the full requisite knowledge of the actual exposures that exist within their own business. And even when they do, the way they express it can lead to a misconception by the industry, by the insurance industry, therefore leading to either restrictions in coverage or higher cost. That can be mitigated, obviously, by either hiring expertise to help them, such as an independent consulting firm, or the broker, which will give them the best view or interface to show their exposures in a light which will reflect the best to the insurer, so the insurer can understand their risk and have the best perception of that risk, thereby granting better coverages and lower cost. Easily said, not so easily done. The issues that arise come in the forms of applications that clients are made to complete, which generally are standard from the insurers and or from the brokers. And we'll talk about those applications so that they can perform underwriting. To the internet, which now everyone refers to. And then how do you express your exposures beyond those applications and what is said through the internet or your web page oftentimes.
Right. So let's talk about the applications first.
So applications are can be rigid. In other words, they are general. So you can fill out the application. The application is, either straightforward, but it really doesn't allow for the client to emphasize certain aspects of their perhaps operations that mitigate loss or exposure, and all of those things. And they tend not to go past just the completion of the application. Further, the application may, oftentimes in the case of business interruption for property and so on, not take into consideration many other aspects of the business, such as they have different manufacturing facilities that can be converted to make the same product if that product in the one facility was to be destroyed. They can make it somewhere else. Therefore, if they lost that particular building, they wouldn't really lose any business interruption, and the insurer would actually make them as much as they can make that product at another facility. But the application doesn't ask that. It just asks for, what's your sales minus costs, boilerplate, and then it'll come up with this is the exposure, but in reality the exposure doesn't exist.
Is there a way to get around that or solve that issue where you can provide custom information, let's say, in order to best represent yourself?
Sure. There is. One is that you question the application. You work with your professionals and outside parties, if necessary, your accountants, your consultant possibly, to understand what's being asked and then how to best address that such that it puts your company in the proper light. You also must understand that applications are not only used to provide information for which the policy will be underwritten. Sometimes applications can actually become part and parcel of the policy. Therefore, even answers that you put down, if you cavalierly write something or you don't understand the nuance, it can come back and seriously influence negatively the payment of a claim.
Interesting.
Those areas, well, one is actually directors and officers insurance, where the application actually becomes part and parcel of the policy. And then others, such as crime insurance, which the moment a crime happens, or for that matter, any other coverage which is using an application, the insurer immediately goes to that application and says, well, wait a second, did you do all of those things what you said you were supposed to do or said you were doing in that application? And in fact, if you had glossed over it or answered it in a way that could be subjective, you could end up with a problem. Particularly, we have found that in the crime, also in professional applications for errors and omissions, cyber, where a client may put information down and it either was going to be in process, but it actually wasn't at the time they did the application, loss occurred, and so on. So you really need to be very, very careful when you fill out these applications, because they can come back and cause issues at the time of loss. The same is true on any schedules given, values, etc. They really need to be correct and be appropriate.
Okay. Well, speaking of things that can come back and bite you, what about the internet and information that's on there?
Well, that's interesting, because many times it can almost, in some cases, be comical, because not only is the underwriter or the insurer going to be looking at the application itself, but they're also going to, in quotes, Google your business or operation, go to your web page, and I've had classic examples of products that our client doesn't even make, that's on the web page now, because most web pages are used as sales tools, and those sales tools are great, and the web page is fine for that. But when an insurer is looking at the web page, they're looking at it from a risk standpoint. So if you're saying that you're one of the funny examples we had is we had a plastic seat manufacturer who basically did a very benign plastic seat, but at the same time, listed on their webpage toilet seats and handicap seats and all kinds of things.
Right.
And the fact is they actually never made any of those. They had no sales in those areas. And when questioned before we sent it out, I said, what are your sales in that area? And they said none, but we would like sales in that area, so we advertised that we can do it. And interestingly enough, a number of insurers came back after they had gone and said, well, what about these? Because it would have completely changed their risk profile, and we had to explain around it, and we were proactive with it. But in the
imagine that positively affected
well, we were able to, we were proactive in going through it and explaining it, and the broker was, good about it, and we invited the underwriter in, and also just perception in general. For example, we had a client that made, dry cleaning plastic bags, but, everybody has an image of plastic bags, and perhaps a child gets wrapped in it and may suffocate. Well, the truth of the matter is there's never been, as far as we knew at the time, never been a loss from a dry cleaning plastic bag, because it's perforated on the top, it's open on the bottom, and anybody that wanted to get out could get out. And we walked them through that, and we challenged them to find any statistical evidence of whatsoever as to that aspect. Another was we had a dye stuff company, and you just mentioned the word dye stuff, and they're thinking about all kinds of exposures. We invited them to the company, and we were telling them that our dye stuff was non-toxic and had no real issues whatsoever, and we could see that they were fairly skeptical. And we had set up our head chemist actually had it, took it out of the barrel, put it in some water, and just drank it, which eliminated any thoughts of that area, and improved the point, and actually the cost dropped in half. And the joke is, well, we never saw the chemist again. That's not true. Everything was fine, but it's an area that it's a perception. So it's not only what you have, but oftentimes you're fighting a perception that's just out in the general public, and you need to get past that and make sure that message is heard. Also, one of the things that we ask oftentimes when we're being interviewed is, do you know what your insurer knows? And typically the answer is, well, my insurer knows what we've provided to the insurance broker. We've given our information and so on. So, well, that's an interesting answer. I said, but just like in a telephone, when you played telephone when you were in kindergarten, you whisper in the ear of the one person, so that by the time it gets to the third or fourth person, you said train, and they're talking about raindrops, for people down. I said, do you have a copy of the underwriting file that was used either by the insurer and or the broker and or the worksheets? And oftentimes they say no. I said, well, that's information that you should have because it's representation. And when they ask for it, not all the time, but often there are nuances as being presented that are not quite correct, or got either dropped or misplaced, and that were critical. It's not that it's nefarious; it's just that it happens in a chain. So you really want to make sure you can correct that as well. So we established the foundation of best knowledge equals best result, and all three parties should have that for the purposes of the risk transfer for each and every exposure that you have or coverage that you're purchasing. The question is how are you going to get that? And that gets into a bit of nitty gritty, and we will talk about that. One of those is, okay, I want to select I want to select a broker, and I don't want to deal with three brokers. I only want to deal with one broker. So what's the pros and cons of that? Well, the pro side is that you have one point of delivery or access. You have hopefully that one has dedicated enough resources to understand your business and will be able to filter that properly, and it takes less time from you and your staff to communicate, and hopefully will end up with reasonable results. And I use the word reasonable for a reason. And if you're an international, there are only certain insurers that really have a true international bandwidth. But even there, the same pros would apply, but also the same cons. And the con is that if you understand the insurance business and the brokerage business, it'll lead you to a certain thought process for maximization or efficiency. Let's just take the insurers, for example. Insurers are no different than any other business. They have intellectual capital and expertise that is greater or less in certain specific areas. As a matter of fact, some of them are so specialized that they really don't even underwrite any other lines of coverage other than one. An example of that would be for property. You have the factory mutuals, which only write property. You can approach them with a liability risk or anything, and they just don't write it. That's not their expertise. And then you have other insurers which write property, liability, crime, a whole gamut of coverages. But even those insurers that write an entire gamut of coverages oftentimes develop an expertise because of either where they're located, their profit in a certain area, the intellectual capital that they've purchased or acquired in certain areas of coverage, whether it be cyber, whether it be product liability or general liability or premises, real estate, distribution, whatever they may be, they may have developed a very, very specific and knowledge base, which means that they're more comfortable and understand those exposures, which generally mean they will provide broader coverage and potentially be far more aggressive in their pricing because they have had great experience. The same is true of brokerage firms. They oftentimes have, it's like people, it's just like management. Some are very good in certain areas, even though they may represent a whole group of insurers. They may have relationships with certain insurers because of the type of businesses that they've either specialized in because they have gotten a lot of business in that area and have a good knowledge base in that area. So in the end, there are, as we like to say, there's horses for courses. In other words, there are certain you will get a better result if you utilize a specific access to that specific insurer who has that expertise. And then the question is, how do you know that? How you as a client going to know that? Well, that can be, the hard part, because unlike aspects in your own business where you may have 100 parts that you utilize to manufacture a product or distribute or whatever it may be, or a service, you are intimately familiar with all of those supply chains, who makes the best one, backups, et cetera, et cetera. So you're very familiar. When you step out into the insurance world, you just simply may not be, and you're relying upon the broker who you may have gotten through your trade association, a competitor, a relationship, and they may be doing the very best that they can, but they simply don't have that ability to either take it to the next level, or the other route, which sometimes larger companies take, is they simply say, look, we're just going to use a very, very large brokerage house, an alpha house, and
they assume they can do everything.
They assume that they can do everything. They have, worldwide knowledge. They're large. They have different teams and so on. But the fact of the matter is, insurance is still about people and their knowledge and their different teams within those organizations, which could be very good in some, not so good in others. I always try to make the analogy of don't fall into the trap. I call it the all-weather tire trap, which is when all-weather tires came out, everybody said, "Oh, this is great. It's going. It's one tire. I can use it. It's good in the winter. It's good in the spring. It's good in the rain." But when you talk to a person who understands tires and understands the chemical compounds and so on, in their world, or in the tire manufacturer world, an all-weather tire is not so good in the summer, not so good in the winter, or adequate. So if you really want the best, then you have to, taking that analogy to the next level, where tires mean so much in Formula One racing, where you always see they're changing tires so quickly and so on. They will change tires if the temperature changes just a few degrees. Moisture in the air changes, because that tire is the only thing that makes that car touch the road. The same is true of insurance. There is expertise out there that can deliver the best for you if you know how to get to it. It makes it difficult. It's not impossible. That's why firms like ours exist, and others. But it's a process in which, if you're not going to buy outside help or internally develop that knowledge base, or have a whole risk management team and so on, then you're going to rely more and more on the expertise of your brokerage firm, for which many of the clients, we're going to talk about this process because we have that as well, which is they take the approach of, okay, well, I want to interview 3 or 4 brokers which we know have knowledge, and we want them to do a conceptual, in quotes. The conceptual method is the brokers come in, they put together a presentation, they're giving information about the company, and they basically say, this is what we're going to do for you. Most of the times it boils down to 2 or 3 pages of, other than the expertise and so on, of you need to look specifically at the strategy that they're going to employ, the results that they can prove that they've given, and potentially making them have risk in the process. most times what we have found in that conceptual basis is that when clients run that, they get taken in either by personalities, the one that has just a better presentation. I'm talking about the conceptual, the graphics, the data, and all of that. But in fact, never deal with whether they actually have the relationship and can prove that they've actually delivered it, and back that up, and not only back it up, but also potentially put themselves, at risk. One particular example that I recall is our client wanted to do a conceptual. We said fine. We pointed out the pitfalls, and the major pitfall is they can say they're going to achieve all of this. Unfortunately, once they're picked and you let them loose to the exclusion of everything else, if they're failing and they're not able to achieve for whatever reason a week before, then you're going to have to accept whatever product that comes in because you just have no backup. Hence, we'll talk about the competitive model in a moment. But that's the major problem in what we call the conceptual model. It's conceptual. It's not reality. The competitive model is one which it takes far more work, in which you have to interview many different brokers, specialists in whatever different areas they may be in, choose and have certain of those brokers compete. You have to allocate markets. You have to be able to understand which one may have more leverage or has had better results with them in the past, and going and looking forward. So who's going to guide you in that? You have to have institutional knowledge within the system to understand that. So you either have to have it internally or expertise brought in on an independent basis, so that you make the right choices or the best choices. And in that case, you always have backup. You know on a competitive basis what other insurers are doing. You've tried to access them in the best manner, and the results should be the most advantageous. Except it takes time, knowledge, and oftentimes additional monies that you may have to spend for that expertise. Therefore, the size of your insurance program may dictate that that's impossible, because if you're spending $100,000 or $200,000 or $300,000, hiring an outside insurance advisor is most likely not going to be cost effective. It may be coverage effective, it just may not be cost effective. So there's a certain size and complexity that a business has to reach in order to make all of that work. It works. It's just financially potentially not functionable at certain levels. How do we? The next area that comes up is oftentimes how should the broker be compensated? Well, the two areas which always come up is, should they be on a fee basis or should they be collecting commission? Well, let's just talk about it for a moment. If a broker is working on commission, if the premium is going up because it gets audited, for example, your business grows by 20% during that year, the insurance company comes in and audit, whether it's workers' comp or GL or your sales went, and you now have an additional premium of 20%, that broker will get an additional 20% for that commission on that. And they may have done nothing, for it, but it's a commissionable item. The same is true if you audit less sales or less payroll, they have to return money that also comes out of the broker. So it's a give and a take. Always remember that it is unlikely that costs get cut, because I don't think there's too many people around that voluntarily cut their income. So you have to negotiate and be aware of the system, if you will, that the broker has a contract with the insurer, has a contract with you, and is also part of the transaction, which means there can be conflicts of interest, and that's okay. You just have to be aware of that. That's the system, and manage it. The fee is generally a set fee, and it's earned normally, the majority of it, the moment the insurance is placed. Therefore, if you decided that the services of the broker are not really good and so on and so forth, or you change insurers midway through, etc., that fee is earned. At the same time, the fee is the fee. So if your business doubled, then that broker typically doesn't earn any more money. That fee is set and locked, along with services and so on and so forth. And you have to be careful, because of the fee agreements. Oftentimes, the main thing that you really need to be careful about is, and I always say this with all, if the relationship ends, either with the insurer and or with the broker, what happens? What happens to your information? What happens to claims that are still in existence that may have to be monitored or fought and or collected on? So that broker has collected the commission and or that fee for that time period. Oftentimes in the agreements, the moment you cancel or the broker is let go or not renewed, that contract says that they terminate their services. So you could have a whole bunch of claims and so on and so forth that are going on that now are no longer being monitored by anybody, and the new broker may say, listen, I'll take them over, but I need to be paid for that, and by the way, I don't have the expertise in it and files and so on. So you really need to understand, anytime you're doing a contract for a fee, the specificity of what happens to your claims, what happens to the entire exposure that's being covered by the insurance contract, and the services that broker is performing for that contract. Does that continue? And if so, is it going to continue at the level that you want? In other words, you don't want to go from the A team to the C team, even if they are handling those claims going forward. So all of that is in a mix. A lot to think about. I've touched on, I think, a fair bit of it.
Large swath of variables that are part of the insurance procurement process. Absolutely.
To wrap it up, as I always like to say, the most educated person, the person with the most intellectual capital, will always achieve the best risk management program from the client's perspective. So if you feel that you either don't have it or need it as your business grows, you should either hire it internally, purchase it from the outside, recognize that oftentimes even the broker that you're utilizing, even with the best intention, may not be able to fulfill or maximize the results for you. So you may need some help, particularly when the dollars and the exposures get greater. And it should not be adversarial. It can be certainly cooperative, and the best results will be achieved in that manner, so that the system or the industry can put out its best product and its best services to fulfill your risk transfer, so that you have the best protection and your company is protected protected in the best manner that it can be.
Well said. So there you have it, folks. You know your business better than anyone else, and are the X factor as far as representing the adequate exposures, picking the right broker, as well as choosing fee or commission basis in the remuneration of that broker. Tom, thank you very much. And if anybody has any questions, please don't hesitate to call or contact us. And it always starts with a conversation. Thank you.